Good day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and I just want to say Happy New Year to everyone. Last year kind of went out with a pretty big bang, and it followed up with the start of the year at a bang. Unfortunately, we saw a lot of pull off in the market and in the Treasury. So we're going to look at the unemployment numbers that came out last week, and then we'll talk a little bit about rates. Overall, when we look at the employment situation report, we saw about 312,000 jobs created. That was fairly robust and above what was anticipated. However, I do anticipate next month, when we see January numbers coming out, these to be coming back down. But when we look at the jobs that were created, overall, we can see the impact on the unemployment rate. It actually went up. Now, the unemployment rate went up because there are more people that entered the job market. So there's a bigger pool of individuals looking for work. And therefore, we saw the U6 number remain unchanged. And how that happens is a lot of these individuals that were maybe discouraged or not looking for work are now looking for work. So that pool of those individuals looking for work has grown and therefore increased the overall unemployment rate, that official number, up to 3.9%. When we look at the types of jobs created, we can see that construction contributed about 38,000 jobs and manufacturing about 32,000. So we see these positive numbers here in terms of manufacturing and construction. We also see that the healthcare and social services number continues to be strong, contributing 57.9 thousand jobs in December. So we continue to see that robustness in those fields. And then we have the overall retail sales contributing about 23, just less than 24,000 jobs. And then that personal or the professional and business services contributing 43,000. So we had a pretty good distribution over a variety of different industries with these job creations. So that's a big positive. Now the impact, though, has been that the overall hourly earnings continues to increase month over month. So we see the average hourly earnings up 3.15% year over year, and we continue to see this number climb. This is historically going back, and we can see this upward trajectory that we have throughout 2018, which is what we anticipated just because of the tight labor market. We continue to have more individuals or more job openings than individuals looking for jobs. So we still have that kind of mismatch, and therefore we anticipate continued increases in the average hourly wages. And you can see coming back prior to 2008, that average here more closely to 3.25% to 3.5%. So that's what we anticipate us getting back up to that over the next year. Flipping from there and looking at that Treasury market, as you know, we've seen this real big downward trajectory in the overall 10-year yields. We talked about this in our last briefing. We hit the high in November on the 8th in 2018 of that 324, and then we kind of worked our way down on Friday at 2.56. And here this morning we're looking at it at 2.65. So we've picked up a little bit in terms of 10-year Treasury, but the spread between the 10-year and the 3-month continues to tighten. You can see where we are here, only 15 basis point difference between the 10-year Treasury and the 3-month Treasury. So we start to see that continue to narrow, getting closer and closer to that zero mark. And typically in the past, that has predicted a recession in the next 12 to 18 months. So we'll see if we do in fact dip down below that zero mark. But a lot of news came out about the Fed, and when we hear the chairman speak and the different presidents, we start to see movements in the market, and this is the implied probabilities chart. And one thing that really stands out to me is the fact that we have no real rate changes built in for 2019. We remain the same in that 225 to 250 range. In fact, if you look over here, the probability of a rate cut has crept up, and by the January of 2020, we're at a 33.1% probability of a rate cut. So that's something that's really new over the past month, that we see these projections, the probabilities of these rate cuts being enhanced like that. So it will be an interesting year this year, even though we see these probabilities on the Fed funds remaining flat for the most part in terms of where that rate is. I still anticipate those CD rates and deposit rates in general to continue to move up as we see deposit chasing in here. We look forward to talking to you again. Have a great day, everyone.